First of all, welcome to the panelists. Would you like to introduce yourselves?
Thank you very much. My name is Previn Singh, everyone. I'm the head of digital assets and DLT at Credit Suisse. I've been working in the industry for about 29 years across multiple investment banks. So I've worked at Goldman Sachs, Morgan Stanley, Deutsche Bank, and Credit Suisse.
Yeah.
Hi, my name is Basima Khuram. I am the International Compliance Lead for Digital Assets at Bank of New York Mellon. I worked in the compliance sector for about 15 plus years now.
Great. I'm David Cunningham. I lead our strategy and partnerships globally for digital assets within our Treasury and Trade Solutions business, so our payments business effectively. Before this, I've been CEO of various RegTechs, often at events like this, trying to sell to big banks like Citi. So I suppose I joined to go the other side of the table and do our partnerships, but also lead out our strategy in the digital asset space.
Thank you. So I would like to urge all listeners to submit their questions through the Brella app. There is a Q&A button where you can submit questions. And then I would like to ask if there's anyone in the audience who is new to the digital asset space and would like us to explain different industry terms as they come up. Okay. Doesn't look like it, so we can just move along. Right. The first question is, what is the current institutional view of cryptocurrency? Basima, would you like to answer?
Yeah, I think from a BNY Mellon perspective, we think that digital assets are a new asset class. We believe that with the power of the blockchain technology, we can shape the future of the financial services industry. Has great potential, and we categorize digital assets into three categories. Mainly, number one, cryptocurrencies. That's your virtual currencies that are not backed by any real-world assets, but are enabled by the blockchain, Bitcoin and ETH being examples. Number two, you have reserve-backed assets, digital cash, which take the form of different types like CBDCs, stable coins. And then you have number three, your representation of tokenized assets. That is, you have your real world assets in the financial system, which can be represented on a token, or even digitally native assets, which can be issued on the blockchain. We currently at BNY Mellon are aiming to extend our asset servicing capabilities to service digital assets to our institutional clients who trust them with us with an integrated offering and solution. We have launched to this effect different types of services, digital asset fund services. We are a leading provider for fund services to digital asset funds, including those of Grayscale Investments in the US. We're also launched in October of last year, an integrated digital asset custody platform, the first integrated offering from a GSIP that combines the best of both digital and traditional assets. Now, clients want to take that journey with us because of the good governance principles, client asset segregation, risk management, and strong regulatory guardrails that they see with us. And in terms of what they think of a forward journey is we continue to see increased demand in both Bitcoin and ETH from both our existing and new clients in this space. They want to take that journey with us. They want to know the technology. They want to understand the wallet infrastructure. They want to see the security and technology standards that underpin this technology as well as growing the potentiality of the distributed ledger technology as they invest and allocate into these assets for their customers.
Thank you very much.
Yeah, so I need to go. Yeah, sure. Basima, I think you should keep talking actually, because when you were talking, everybody came in. So I think you're resonating. But no, I really like your points. I suppose at Citi, and don't want to preempt a talk I'm giving in a little while on this here as well. cryptocurrencies, I suppose we look at them as, to a large extent, unregulated. They're not liabilities of a regulated institution, and they're often token-based rather than account-based. Of course, we have difficulty, as all large regulated institutions have, with unregulated assets. We try to, while some of our clients might like to hold them, particularly in our wealth business, the cryptocurrencies themselves hasn't been something that we've really got behind. Let's say we're much more interested, I suppose, in what their rise as largely a speculative asset has ushered in, which has been a huge push by central banks globally, and let's say the European Union trying to push their CBDC. I think the idea, we put stable coins and cryptocurrencies in kind of the same area as unregulated non-liabilities, and what we've seen really is when Facebook and DM started their move, we saw a lot of central banks globally make a push to say, we don't really want a large company to really own this space and have 2 billion customers and do this. Not that it was new. I mean, there was talk of an IBM dollar back in 2002, but it really accelerated the CBDC discussion. But I think what's been interesting is there's been, at conference like this, it's usually a discussion around CBDCs versus stablecoin. What's going to be the thing that enables commerce on a global level? I'm not sure either will be. I'm quite bullish on the idea of commercial bank money. Tokenized version of that, the same legal instrument written on a different ledger, which happens to be distributed, whether it's private at first, enabling commerce. Because I think what's important is, if you look at stablecoins, for example, the total market cap of that globally, of all of them, is 150 billion. We move 6 trillion a day just within TTS, my division. So, we'd need 40 times the amount of stablecoins just to help move money. And it's also, if things are one-to-one backed, it's there's not enough liquidity in the world really, to enable that to happen outside of commercial bank money and that. So I think they've captured the imagination. They have, proven that technology can work, and to a large extent at scale, and has set up an interesting digital money format race for the future.
Okay.
Yeah, I just might want to sort of add to that. Really, to be honest, I think we're in a similar situation. We don't offer cryptocurrencies as a GSIB, which is heavily regulated. They don't really sit well with us. And I just wanted to give you a bit more detail as to why that actually is. Things like Bitcoin and Ethereum are based on public permissionless networks. And what that means is anyone can join that network, no questions asked. And that obviously leads to KYC and AML concerns. So for that reason, we're out of that game. But going back to David's point, there's still a gap in the market. As all the assets in the world start going on-chain, you still need some means of payment on-chain as well. So there's still quite a lot to play for here. And I don't think crypto is the only game in town, basically. There's also stable coins and CBDCs. And even within CBDCs, there are two different flavors there. There are wholesale CBDCs for banks to talk to each other and interact value with. And there are also retail ones being touted. So I think, cryptocurrencies, whilst they might be first out of the box, as it were, and get a lot of the attention, they're not the only gig in town.
Yeah, that's a good segue into our next question, which is what's working well and what's missing. So in terms of what you just said, could you elaborate further?
Absolutely. So yes, we don't do cryptocurrencies, but we do get involved with other types of digital assets, mainly in the private and permissioned network space. And what that means is that all the nodes on a DLT network, the distributed technology network, are known participants. So they will be KYC, they will be AML'd. We will know exactly who's on that network. So it's kind of like a private members-only club, as it were. So we all know each other from a regulatory perspective. So in that space, Marcus, we've been experimenting for the last few years, and I think some of the notable things that we've gone live with are things like, last year, for example, we did 2 central bank digital currency experiments. One was with the SNB, the Swiss National Bank, where we tokenized Swiss francs and we tokenized assets as well, so commercial paper, and we did a delivery versus payment all on chain, and that proved it could be done, and it worked really, really well. Why do people get excited? Well, this stuff happens instantaneously. So at the moment, you might have to wait till end of day. Sometimes you have to wait T+2, depending on what your currency is. This happens instantaneously. So we did delivery versus payment, no risk, at an atomic level. So that gets people quite excited. So that was an experiment we did with the S&B, a CBDC experiment. We developed that further, actually, with the ECB, European Central Bank, and did a cross-border version of that, where we took tokenized euros, tokenized Swiss francs, and transacted those cross-border. So we developed that a little bit further. And to be brutally honest, the technology aspects were probably the least exciting elements of that. It's really the rule books and the legal frameworks and the regulatory frameworks, in fact, that were the most work to be done there. But it proved it could be done. Some other examples, if I may, just very quickly. We went live with a bond with SDX, 150 million Swiss francs worth of bonds, fully subscribed, so it shows the demand's out there. And we've had various experiments with collateral transfers as well, which tend to be large ticket items, so typically hundreds of millions of euros worth of value in one ticket size. So those are the sorts of things we've been interested in and working on.
Okay. Maybe Basima first.
Yeah. I think tokenization, we take a long-term view on tokenization and the blockchain technology, the new products and possibilities that it has to offer in transforming the financial market infrastructure. I think this is a key area for us, and I think we're hearing the same from our institutional clients on this space. In our 2022 digital asset survey, we found that 91% are interested in investing in tokenized products. And I think the DLT itself is a great journey for capital markets progression, and our clients want us to be on that innovation journey with them. So that's a key message that we're hearing throughout. And in that extent, I think we're taking that message clearly. When we develop new products, or when we innovate in this space, we're listening to our clients, listening to the demand, also acting within the regulatory safety and soundness perimeters that we know and we can work with, and then taking that landscape of innovation into our mindset as we operate. So most importantly, we collaborate with everyone involved, including the market infrastructure and service providers, as well as keep the regulators engaged earlier on and throughout the journey.
Okay. Now, Previn talked briefly about the open source ledgers versus in-house built ledgers, in favor of in-house built ledgers. I've heard a rumor that one of the original in-house built ledgers called R3 that died because there were issues with banks sitting together and agreeing on something and then running back home individually trying to patent it. So my personal opinion is that I believe in the open source thing. So I would like to hear the opinion from the two others, open source versus in-house build.
I think R3 is still alive and going pretty well. So they are. Yeah, I mean they're a serious infrastructure player that a lot of it's a lot of central banks are using and private entities. They are a pretty good company, I must say. My boss is actually from R3. She came over from R3 and she's pretty good. But I think to your point, the private versus public is important, and Previn made a really key point here, I suppose, seen as this is in a large extent a regulatory space and conference. The thing that I feel is that to build on his point, not only is it that we want the actors to be known who are doing this, certainly for us, the Washington and the Fed, for us, don't like the ideas that nodes can be run and validators can operate on a public chain in sanctioned countries or be run by sanctioned entities. So if we decide, as much as we might like to, connect our own work with a public chain, that might mean that gas fees go to a sanctioned body, and that's not something that our regulator is super excited about, to say the least.
100%, David. I think just our three are very much alive and well. I think some of those examples I mentioned, like the bond issuance with SDX, for example, Swiss Digital Exchange, they're using R3.
Oh, okay.
So in fact, it's kind of like a sign of the success that they've kind of melded into the background to a certain extent.
Yeah.
The collateral transfers I was talking about as well, with an outfit called HQLAX, it's based on R3. So about sort of 5-10 years ago, it was kind of like what is blockchain? You know, we see it in the public space only. How do we tame this stuff? You know, how do we make it usable? And R3, I think, have been largely successful. Going to your point, and I think the point you're sort of scratching at there and covering there is, and the one I'd like to develop actually, is that you can have fully private networks, but they're not as scalable as public networks. So you're forever having to balance scalability on a public network with control on a private network. So it's not a zero cost option. You know, you kind of have to pick your choice and understand there are going to be limitations with it. Right now, for GSIBs like us, globally systemically important banks, we like to use private networks for that reason. It offers us the right risk-reward profile. So yeah, I think, and also I think, Basima, you mentioned earlier on that customers come to us because we are trusted partners, basically. You know, they don't want some thinly capitalized fintech that's pretending to be a bank. To be their partner of choice. They really want somebody with capital adequacy rules applied. They want somebody who's got deposit insurance, people who've got client money separation. So you know, these are sorts of things I think are almost as important as the technology stack.
Yeah, no, I completely agree with that, and then we will get that when Mika arrives. So hopefully we'll move in the right direction.
And I think to your point about, you know, what's missing in this whole ecosystem, it's really that scaled up use of protocols and networks which facilitate interoperability as well as, you know, and that helps us to pass down the benefits to the customers, to have to build up trust and strength in the whole system without having to, you know, fall foul of key regulations and core principles of you know, customer identification, privacy, and security technologies. And I think from, you know, GC Bank's perspective as well, like, addressing the reputational risks of providing traditional banking services to fintech or digital native clients is, you know, that's the more regulatory clarity we have, that can help reduce the friction in that process.
Okay. But and then...
No, do you mind if I add just, I think Basima, interoperability is going to be the name of the game. And I think we authored a white paper called the Regulated Liability Network. And then together with 9 banks, of which BNY Mellon are one, MasterCard, SWIFT, and the Federal Reserve, you know, we're just quite soon, at the end of this month, going to publish the reports of a 12-week POC that looks at regulated sovereign money. It looks at the interoperability between various banks and organizations. And to Previn's point earlier, the technology is not the challenge. It's the system, you know, how you systemize the processing of these things between various organizations. So if a regulated blockchain-based infrastructure is going to emerge, these things take time. So, I mean, probably seen as everyone in this room, including myself, have been in this room many times at this conference. We're probably all RegTech nerds, so we're probably all were, 13th of January 2018, thinking, oh great, here comes PSD2, and open banking. It arrives. Anybody else nerdy in that manner? Do you remember that day? And we were kind of excited about it. And then we had 25th of May, GDPR came in that same year, so it was like a bumper year. So I don't know if you were in the same situation. Maybe you were going through pain in a large organization. I was going through a different type of pain in startups, where I was expecting the floodgates to open, where my solutions would be purchased by all of these banks. And I think you probably all know it took a little bit longer than we expected for everything to come to life. But I think as Bank of America was launched by Bank of America in 1958, and then Visa emerged to systemize the back office processing of credit cards and became a co-op. These things took time. As SWIFT emerged, and various participants like ourselves, brought our flow to that. Again, took a while to systemize how things went. Things like the regulated liability network are a way of exploring how we might set the foundation for a blockchain-based infrastructure. Again, I'll be going into a bit more detail about this later on as I plug my talk at 3:50 later today.
No, that's a really good point, David. Actually, I think it's just worth mentioning. We use the term DLT network, and the word network is actually the most important part of that phrase. I think it's all about network dynamics. So what I mean by that is the value of that network is proportional not to the simple number of users. It's not a linear relationship. It's actually a power relationship. So let me explain what that means. If you had the first telephone in the world, just one telephone in the world, it would be pretty useless. You couldn't call anyone up. If you had two telephones in the world, suddenly it's a little bit more useful. So it's not actually just 2 times as useful. It's actually 2 squared. So the number of participants on a network squared. If you had 3 telephones, it's not 3 times more useful. It's actually 3 squared. So the number of users on that network actually exponentially increases the value of that network. And because of that, you're going to find common standards are going to be something we really do want to have. We're not just paying lip service to this stuff. It's absolutely vital to the value of the network. So common standards are hugely important because it brings network players into the space. Lock-in is not going to be encouraged, right? We're not going to want to try and own it the way that Microsoft tried to own Windows. That's not going to happen either. So we're trying to open up this ecosystem because the number of participants is what drives its value. So I just want to get that point out there. The network word is very, very important to us.
Okay, but I'm happy that you see it that way, because that's one of my concerns going back to the open source versus closed self-built solution was the.
So we can't have a winners take all thing then, no? I'm joking. Yeah, no, we're absolutely believe in the interoperability, but I think for this audience, whether you're a startup or a company that's helping large organizations deal with regulations and has gone through the pain that we all went with the establishment of open APIs and things like this, the level of expertise in the room here, applied to digital assets as these things emerge as a global financial market infrastructure, it's the same stuff you've been doing elsewhere, just with a new topic. So lots more opportunity for the companies here. I feel for the consultancy businesses. Again, they're going to do pretty well. So yeah.
But also just I know you sort of jokingly said winner takes all. I think it depends how you define winner. To be honest, I think in that context, the winner would be the network with the most participants in it, the most banks, the most users, and actually the element that's kind of missing in this debate is the most third-party developers on that ecosystem. So think about your iPhone, for example. Why is that so successful? Is it because Steve Jobs did a great job all on his own, or did he open up the App Store and make it available to hundreds, if not tens of thousands of people across the world to develop their own apps on there? So that's why the value of the network is so important. If you have a large network, it attracts other developers as well. But back in the 90s, there was a huge sort of almost religious debate about whether open source or closed source would win. And a really useful example to look at is encyclopedias. Okay, so if you think about Encyclopedia Britannica, which is a very closed source, everything was done in one building. There were editors, there were contributors, they were all on a payroll, they were all in one building. If you look at what's now superseded it, in retrospect, which wasn't obvious back in the 90s, but the thing that superseded it is Wikipedia, which is very light in terms of organizational capacity, but it's also heavily staffed by volunteers, people not necessarily on the payroll, people who just want the bragging rights for the definitive article on Led Zeppelin or wherever it might be. But the idea is that you've got a large number of people thinking about contributing to Wikipedia. And I think if you harness some of those network dynamics, DLT has a real opportunity here that standard software and fintechs don't really have. So there's a slightly different dynamic because of the network.
Okay. So next question. What do you expect regulators, how do you expect regulators to respond to all of this development? Maybe Basima first.
Yeah, I think that there's some real positive developments. Most recently in Europe, especially with the launch of the MiCA regulatory framework. In the UK, there's the Financial Services Bill, and we're seeing similar developments globally as well. But the EU is the first major jurisdiction to create tailored for the digital assets world with the launch of the MiCA regulatory framework. And I think from BNY Mellon, we support the creation of the framework because I think it allows for the development of the market for digital assets. It puts in, it's the first of the number of long list of technical guidelines and everything that's yet to come, but it is initial and it's a great pivotal point, let's say, in the regulatory industry.
Yeah, completely agree. Maybe anyone else wants to?
I would say a few words on MiCA, actually. I think it kind of gets lost as to how important it actually is and how beneficial it actually is. I mean, MiCA, for the uninitiated, stands for Markets in Crypto Assets. So it's not just regulating products, it's actually regulating those products in a market context. So they've got the gist when it comes to this thing being a network ecosystem play. It's not just about individual products and regulating those. It's actually how they interact across the entire market space. So the clue's in the name there. The thing I like about it is it gives, first of all, it opens up a large sector of the world's market in terms of if you get MiCA accreditation, you can actually market across the whole of the Eurozone, which is fantastic if you're a fintech. If you're in the RegTech space, that's something to be looked at in more detail. So economies of scale are something that come from that. The other really forward-looking thing about it actually is that they didn't wait for everything to be known before they legislated. What they've done is sensibly bitten off the bits they can deal with today, and they're giving you the best first step in that process. Now some detractors in this space might say, I've heard sort of Bitcoin maximalists say this, it doesn't cover decentralized autonomous organizations, it doesn't cover NFTs, so therefore it's all no good. Now, I'd counter that by saying those things are naturally much more fluid and later to the market, as it were, but it is dealing really well with tokenized traditional securities, for example. It's dealing well with crypto asset service providers. If you're a custodian or a payments provider, it deals with those really well. It deals with tokenized money really well. So it's doing the things it does in a really joined up sort of way. And I think it's quite natural to leave it to a second phase. The first phase, in case you're wondering, was approved by European Parliament very, very recently, probably a few weeks ago, and it's now going through the national competent authorities in each jurisdiction. So each country is looking at this now at its own level, and it's going to pass into legislature probably over 2024 and 2025. So in the next year or two, it's going to be there. It's going to be live, which I think is going to be hugely useful. And just my final thought there is the obvious thing with these regulations is they will help participants run crypto asset service provision and help market products in this space. That's undoubtedly true. But the other thing that this offers people in this space is a certainty when it comes to inward investment from venture capitalists, which then in itself will spurn further development. So when there's certainty, you'll get inflow of capital and further development, which is great for everyone, really.
I'm shocked, to be honest, by your comments. I mean, to be sitting in London and to hear such praise for European regulation is it makes me feel like we're coming together again.
I should also point out that the FCA are doing great jobs as well, great work as well with their sandbox and things like that, and that, the financial services bill as well. Yeah,
they
absolutely.
do.
Yeah.
Yes, that's true. Yeah, and just to add additionally to MiCA, I mean, MiCA is aligning the crypto industry very much to the financial industry. So it's taking all the best things from MiFID in terms of market abuse regulations, MiFID and the market abuse regulation, and adding that into crypto and making sure that for cryptocurrencies and stable coins and that kind of stuff, that's suddenly covered, and you need segregated funds if you're a crypto asset service provider and all that stuff. So hopefully MiCA will be the stepping stone to a wider adoption of crypto, because we will get the consumer protection that is in the financial industry today.
And Marcus, turning around the tables on you, I mean, just because I know you're deeply experienced in this space yourself, you're seeing a lot of your customers, let's say, they're appreciating the guidelines and that bit more certainty, or how are they feeling about it?
Well, our customers are primarily digital asset companies, so we see the same difference in opinion between our customers as we do, on crypto Twitter and on LinkedIn and that kind of stuff. So I have customers who want to issue stablecoins who are very angered by the fact that you need to hold not 1-to-1 segregated, but 102% capital for issued coins, and had some conspiracy that US regulators came in and said, oh, you should do 1.2 in Europe because they only do 1-to-1 in US, and that would create some kind of competition imbalance. But I don't know whether that's true. That's just what I hear. So there are pros and cons always, but from my chair as the kind of gateway between the two worlds, I think MiCA is going to be a great step forward.
Yeah, I think it's just worth mentioning. Sorry, but you go first. Basima,
No, I think it's also great for other regulators because there's a broadly facilitative approach within the MiCA, and that allows for disagreements where it need be, and otherwise leaning towards a common standards type of regulatory framework always helps out. In various jurisdictions.
Absolutely, and actually on that last point, various jurisdictions, we mentioned how far ahead the EU are. We mentioned the work that they're doing here in the UK as well. We should also mention that the US are working on this as well. They perhaps aren't as far as advanced as MiCA, but they are thinking about responsible innovation in the digital asset space. We saw last year something called the Gillibrand-Loomis Act for Responsible Financial Innovation, which says a lot of very sensible things about investor protection, financial inclusion, and essentially trying to join up across the whole of the US government to push towards digital assets. So not just the Treasury or tax authorities or the tech sector, they're really trying to push it across the piece. I think when that clarity comes, it'll be even better. But it's just worth mentioning there's work going on in the US too.
Yeah,
I think just on, I mean, these regulations are going to make the people outside here exhibiting, they should have product offerings to kind of cater to large organizations like ours, to enable us to kind of thrive in that, and to help us meet those requirements. All the same stuff that, these companies have done for PSD2 and GDPR, for example. So I think there's tremendous opportunity. It should be a big win for those who are experts in the space. And given the level of expertise at these organizations, and sitting beside me, they're serious about it. You don't have people of your caliber speaking so knowledgeably about this stuff unless the organization itself is really serious about how they're going to play a role in the space. So the opportunities for those here, for startups and that, even though when I walk around Shoreditch now, it's a different scenario than 2018 when every building was packed. I see vacant buildings there. The VC squeeze, the startup difficulty, there's empty buildings there. These type of things, this type of regulation helps grow startups, makes some, there's going to be a lot of money made for startups, for VCs and that, and hopefully those buildings will be full again.
Yeah, and not only crypto startups, but also RegTechs. Basima, I know you had some comments about RegTech's potential in this space.
Yeah, I think it's an opportunity, as my co-panelist said. Like we're at this place where we're just starting off on the regulatory journey. So the opportunities and the potential for exploiting the underlying technology itself for creative, innovative solutions to foster more, digital identity solutions, for example, building up layers to automate within that space, as well as to offer more on-chain and off-chain blockchain monitoring, as well as a combination of fiat and blockchain monitoring. So those type of integrated solutions are more than welcome, and I think the regulators would love to see them as much as other financial institutions like us.
Yeah, I totally agree. I just wanted to add to that point as well, which is there's a huge opportunity basically for RegTech, and a lot of that is if you think about the world pre-DLT, let's say there's 30 GSIBs in the world, there may be quite a few different technical stacks you have to deal with as a RegTech operator in that space. Put very simply, you might have to deal with SQL Server, you might have to deal with Sybase, maybe you have to deal with Oracle, maybe you have to deal with databases you've never heard of before. But there's a lot of fragmentation, a lot of extra work that RegTechs would have to do to cater to that market. Now, if you fast forward to where we are now, where we're going with DLT, if you've suddenly got a golden source on DLT that, say, 30 participant banks all have, it means you've got the same data model. across 30 banks. And what that means is if you're a RegTech provider, you've got to develop once and you can sell 30 times potentially across the entire network. So it makes your job in terms of marketing a little bit easier, and it means you get volume and scale much more quickly too. And this is kind of what I was alluding to earlier on when I talked about the Apple App Store model. The value of that network then starts becoming super apparent, not just to the banks, but also to developers in that space, including RegTech developers.
Yep.
Just kind of back to Basima's point on digital identity. You can't do CBDC without proper digital identity. So the things that the likes of David Birch and other people have been pioneering, talking about for, verifiable credentials, things like this, that's going to be applied at scale in this. I mean, do you believe there's going to be a digital euro or a digital pound, or I think there is. I think it's going to happen. I think UAE is going to happen. I think India, Brazil, we're seeing. CBDCs are not going to happen.
I totally agree, David. I think the fact that you've got something like about over 100 central banks looking at these is interesting. Some of them are actually live as well. In Bahamas, they have something called the Sand Dollar. They have the e-Naira in Nigeria. Obviously, China as well. They've gone live in the wild, in production. So these things are actually already happening. I think your question about some of the major jurisdictions, I read the Bank of England consultation paper on the digital pound, and they're reserving the right not to do it, actually. So they're still saying, we're looking at this, and this is really interesting stuff, but we're not committing yet. And I think it's very similar with the digital dollar and the digital euro. In fact, I think the digital euro had a publication a few days ago, which was relatively bearish about this. But I think it's not a given it'll absolutely happen, I don't think, but I think that the momentum seems to be suggesting that it's going to happen somewhere. Yeah.
And then we have a question on Umbrella. We've been talking very much about crypto for now, but the question is, how do you see the metaverse playing into all of this?
I think, we're lucky to be even speaking here as digital assets people. I mean, it should be all AI at this stage. Metaverse seems to be last year even more so. So maybe we're on the last invite here to this type of event. But I do think that once the user interface becomes better, and it's augmented reality perhaps more so than that, I think it'll go. A big shout out to my colleagues in Citi Global Insights. They wrote a huge 170-page document which talks about money in the metaverse, which is absolutely fantastic, and just recently published a digital asset one that talks about 11 trillion worth of digital assets by 2030. So they've got some great stuff there on if you just look up money in the metaverse city or money tokens and games. I do feel that it's my kids, hopefully not just them, but it's kids of my generation, children the same age as my kids, okay, not just mine, that have grown up with Roblox, with skins, like with real value that is digital representations of the stuff that they value. I think that's and as they live more and more aligned and the interfaces become better, I think, it's definitely going to be a play. But I think there's, if I was back in the startup game, I would be less focused on the, given a RegTech background, I'd be less focused on the metaverse. I'd be more focused on how can I provide the tools and the picks and shovels to enable large organizations meet their requirements, regulatory requirements for digital assets globally. And I think, that's what I'd be going after.
Yeah, I think it's a valid point. I mean, at least in Januar, we don't differentiate as much. The metaverse is more of a UI to the underlying blockchain infrastructure, in a sense.
Yeah, I think really with metaverse, it's really useful to think about it in terms of it being a digital environment where digital experiences happen. What that really means is if you've got a digital environment, you're going to have digital assets. And as we said at the top of this panel talk, if you've got digital assets, you need digital money. So I think that the push towards metaverse is actually going to add wind to the sails for digital money, essentially, and digital assets in the same breath. So I think they're actually kind of additive in many respects, in a nutshell.
Yeah, I agree. Great. I think that's time. Unless there's a final question. Yes.
Here you go, Dan.
If you all were regulators, what could you give some advice to Binance?
If I were a regulator, what advice I would give to Binance? I don't think I would give them advice. I mean, at least from, okay, I can be candid. My personal feelings about Binance is that I'm very ambivalent. I kind of want them to shut down because I think they're a stain on the crypto economy. but at the same time, they're also too big to fail in the terms of the crypto industry. So if Binance went down, it could potentially collapse or take a lot of other players with it. In the same way we saw Celsius and AC3 and FTX and those companies pull down a lot of other companies. But yeah, I can't say whether Binance is crooked or not. But for me as a risk manager, jumping jurisdiction every other year to avoid the inspections, that seems like a red flag.
Oh, the freedom you have to speak. Huh? Oh no, our mics have stopped working.
Yeah.
The one thing I would say, I can't speak for a regulator, but what I can say, I can speak as a fellow participant in that ecosystem. So let me speak from that perspective. I think our friends at the BIS, the Bank for International Settlements, said it best, and I'm going to repeat back what they said and steal shamelessly from what they said, which is if you're in the same business, you've got the same risks. Okay, if you've got the same risks, you should be beholden to the same regulations. It doesn't matter who you are. You could be Binance, you could be Credit Suisse, you could be some fintech you've not even heard of that's in WeWorks right now. 2 people and a photocopier. Doesn't matter. But if you're in the same business, you've got the same risks. If you've got the same risks, you've got the same regulations. And I think we should just think about those guiding principles when we think about anyone in this ecosystem.
And I would like to add, that was my personal opinion.
It is not representative of the fellow members of the stage.
Yeah,
All rights
exactly.
reserved, no recording.
Or my company, just to say. But
Did anyone mention I've got a talk shortly in the other room?
I think you did. Okay.
Hopefully you can come.
Okay. We went a little over time. I guess that's okay.